In part one of this series, we sketched the dimensions of American inequality, tracing in turn the stagnation of wages, the growing wage gap in educational achievement, the polarization of incomes, steadily since the 1970s and sharply since the 1980s, stark gaps in wealth, and the fact that all of these trends are more pronounced in the United States than they are virtually anywhere else in the developed world. Understanding the dimensions of that inequality, of course, is one thing. Understanding its causes is yet another. What contributed to inequality, to the growth in inequality over time, and to the growing gap between the United States and its peers? The first culprit is usually globalization, by which we mean the ease and speed with which goods and services, money, information, production, or labor can move across national borders. Certainly our exposure to trade has increased in the last 50 years. Exports, the red bars on this graph, have grown from about 5% to about 12% of the economy since 1960. And imports, the blue bars, have grown from about 4% to about 15%. And the trade balance, negative since the mid-1970s, now runs about 5% of gross national product. But it's important not to overstate this. The footloose mobility of capital is a useful myth, but the world is not flat. Indeed, most of the economy is rooted in place by labor markets, by supply chains, or by consumers. More to the point, there's no clean and clear relationship between exposure to trade and inequality. As we've learned, wage and income inequality is starker in the United States than in almost any other developed nation. Yet, as we can see here, the United States is less exposed to trade than any of its international peers. More important among the various dimensions of globalization is the dramatic increase in the global labor supply. With the integration of China, India, and the former Soviet bloc into the global economy, the supply of labor has essentially doubled. This has skewed the global ratio between capital and labor in such a way as to dramatically increase the ability of firms to move production or to wring concessions from workers in exchange for staying put. The most substantial and consequential challenge of all this is what economists call skill-biased technological change, best understood as a growing demand for workers with particular skills, coupled with an increase in supply of skilled workers from outside the United States. Skill-biased technological change displaces routine manual tasks, such as working on a production line, and in the process creates new tasks and occupations for which skilled workers are more adaptable. But it does not displace many non-routine, low-wage service jobs, and so it results in a polarization of the labor market. Consider, for example, these sectoral patterns in the United States since 1979. We see substantial losses in the middle of the labor market in sectors like administration, production, fabrication, accompanied at the same time by growth at the edges of the labor market, in low-wage, low-skilled jobs at one end, protective services, food preparation, and in high-wage, high-skilled jobs at the other, managers, professionals, technicians. While all of these trends are important, their contribution to inequality is easily overstated. Technological change, increasing productivity and demanding new skills, is not new to the last generation, and has progressed across eras of relative equality and inequality. In turn, it's easy and important to recast this as a political question. The problem is not the inexorable and unpredictable pace of change, but simply the gap between the demand for skills, shaped by technology, and the supply of skills, shaped by education. That gap may well grow because growth in educational attainment is sluggish, not because the rate of skill-biased technological change is accelerating. The punchline is this. globalization need not be a race to the bottom. Given sufficient investment in education and protection for those workers exposed to new competition. Indeed, it's pretty clear that globalization widens the wage gap within and across countries, not universally, but where and when labor protections are weak. The second culprit is demographic trends, particularly changes in family composition. Since income is a household measure, the rising rate of single-parent households is often invoked to explain inequality. On this graph, the bars capture the share of all families by family type. So married with a wife in the labor force, married with a wife out of the labor force, single male household heads, and single female household heads. And the lines of corresponding colors trace median family incomes for each family type since 1951. As we can see, the most prosperous family units, married with a wife in the labor force, are also in decline as a share of families. Just as the least prosperous, single female head of households are rising as a share of all families. Indeed, the United States is second, only to Sweden in the OECD, in the rate of single-headed families. But this raises an obvious question. If single families are a driving source of income inequality, why are the rates highest in those settings where inequality is severe, the United States, and where inequality is mild, Sweden? The differences, it turns out, are political rather than demographic. Against their OECD peers, two-earner families in the United States do fairly well. Only 5% fall below the poverty line. But U.S. families with only one worker, over a quarter of which fall below the poverty line, are at a much sharper disadvantage than similar families elsewhere. At the same time, the presence of kids in the absence of family leave and publicly supported childcare, found in much of the rest of the world, is a distinct economic burden in the United States. Childless American households have one of the lowest poverty rates in the OECD, at under 6%, while households with children in the U.S., at nearly 20%, have one of the highest poverty rates. Finally, among these demographic trends, we turn to patterns of marriage, and particularly what social demographers call assortative mating. Now, much has been made of the fact that men and women are, over the last half-century, decreasingly likely to cross an education or income barrier when they get married. And they're more and more likely to find themselves in homogamous marriages. In crude terms, as it's often put, in 1960, doctors married nurses. Today, they marry other doctors. Well, this is an attractive explanation because it's seemingly driven by personal choices immune to political intervention. But it's not a very good explanation. Best estimates are that assortative mating might account for 10 to 15% of the income gap between the poor and the median, and little of the gap between the median and the rich. And it's unclear whether assortative mating is best understood as a cause or as a consequence of background inequality. While homogamous marriages might deepen income or household inequality, the choices behind them may themselves be driven by trends in wage or individual inequality. As important as all these trends are, they can't carry much of the explanatory weight. And none offer much insight into the distinct trajectory of inequality in the United States. All of these economic and demographic changes are themselves embedded in a larger institutional and political story. And that's where we find the differences that matter. Indeed, the simplest way to understand U.S. inequality, its growth over time, and its exceptionalism, is to go back to our mid-century sketch of policies, the New Deal order, that sustained both a floor for the bottom of the labor market and a ceiling for the top of it. What happened to those policies over the last half-century is really the important story. And we turn to this in Part 3.